Well, stocks are selling off this hour. Treasury yields are hitting their lowest levels since December. Our next guest is in charge of corporate credit at Goldman Sachs, advising America's biggest companies on their multi-billion-dollar financings. Jonny Fine is back, Goldman's global head of investment-grade debt. Welcome. It's a good day to have you because we are seeing this rush now into bonds, out of stocks, yields lower. I mentioned earlier, markets now seemingly worried more about growth than inflation. What's happening?
So there's a lot of undercurrents, I think, driving current markets right now. I wouldn't underestimate that we're moving into a weaker seasonal period. We've seen some challenges to the thesis around the US consumer. We've seen some challenges around the thesis around AI. We're obviously seeing a little bit of the fiscal impulse turn negative with the spending cuts at DOGE and what an ultimate budget might look like. And so it's no surprise to me that the market's grappling with all of these cross currents that are taking place currently and saying, well, maybe we've come a little bit far, a little bit too fast.
I remember last time you were on, you said you liked bonds, so that has obviously been a good bet so far. Still like them after this rally?
I do, and I think in particular, the conventional wisdom that many have been speaking about for the last several months, myself included, by the way, has been that monetary policy is very much on the sidelines. I think now, all of a sudden, with the challenges to financial conditions that we're seeing, is that monetary policy is going to move to the front burner again pretty quickly. We've now priced in a full cut in the Fed funds rate, an additional cut by the year end. We've done that in the last week or so as markets have started to anticipate that the Fed may react to the environment that we're in.
I don't know, May to May?
Quite possibly. Quite possibly. I think all of the early meetings that we're talking about not being in play, I think all of a sudden we'll be looking for a slightly different rhetoric, especially if we start to see the weakness in broader markets persist in the way that they have. So I actually think markets are thinking, if you look at kind of where terminal rates are a year and a half out, they're just under 375. It wouldn't surprise me if ultimately we get that repriced to a number more like 3.25, which is much, much closer to, I think, the Fed's own estimate of where the neutral funds rate is.
So if I'm a CFO or a treasurer right now, I'm like, Johnny, I got an issue, but I have some time. Should I wait? And what part of the curve am I best sort of going to get the best money from, bang for my buck, so to speak, right now?
So duration's been on vogue for a little while now. The way that the fixed income market structure in the US has evolved in the high yield environment that we've merged into over the last couple of years or so, one of the biggest drivers of our market has been annuity writing in insurance markets and in long-term savings markets. And that needs to get reinvested into the capital markets in the form of longer duration. So we've seen a strong bid in the long end of the curve, really for kind of a year and a half now. Obviously at a lower level of yields that we're at more nominally now, it makes it more palatable, I think, for issuers to consider. So I like the long end of the curve. I think that's where the bedrock of demand fits the best right now. But ultimately, if I'm sitting here and I'm looking at and surveying the environment that we're in, I don't think that I'm immediately rushing to run into the market. But at the same time, you've got to remember that the spread component of financing costs is still very, very close to multi-decade tights where we sit today.
Yeah, where are we right now? And just put that in perspective.
I think we hit the tights maybe kind of a couple of weeks ago. We're maybe 5 to 10 basis points higher than those tights, both in IG as well as in high yield.
If the Fed were to start removing some restriction, would they have to look past some of this hawkish inflation expectation data that we've gotten from some surveys?
I think they'd have to assume that the trend is going to continue to move in the right direction, i.e. inflation expectations will continue to move lower, and actual inflation data that we start seeing play its way through in the real economy is moderating. And that, I think, would be a natural way that the Fed may anticipate, especially if we're seeing a little softening around the edges on the consumer, for example.
Right. You think employment's at risk?
I think employment is probably more a function of what's happening in the public sector, as well as what's happening, and we talked about this last time, with deportations. And so seeing how that immigration trend impacts particularly the lower income part of the worker market. David, you talked about this a lot yesterday with respect to construction workers, service workers,
yes,
and so on. If that starts to have an impact, then you could see wage price inflation pressures there too.